and created REITs and other structures, predominantly in the US, to separate those. Okay, but in real terms, that means separating expertise in today's hospitality world. So you expect the people that own the building to be really, really good at running buildings, and that means keeping the costs down, keeping the building in best shape, and so on. Okay, and you expect the operating company to be the best at the operating of the hotel, and you would also expect it to be the best in the brand management and the marketing of that. Now, it's a completely different debate whether that model works, doesn't work, if it should work, whether a better model is out there to do it or not. As far as this one, sorry? Yeah.
I saw a chart with a occupancy, historical occupancy. How far back you go in the analysis?
I think I have on my laptop something that goes probably 20 years, but
it's been on 80+% all the time.
I think 80 is on the generous side because there have been some declines. There are other issues that are.
I mean, that's why I asked you that question because we have living some benign here, economically talking in London, and you know we are in the top of the cycle, and the cycle is going to go south. The capacity.
I think the best thing is there's a report by Grant Thornton who did it for GLA, for Ken Lewis's lot, and they put an awful lot of sort of brain power into looking at the market, forecasting the market, what are the influences, looking back at the historics, and obviously looking back at the best way to look forwards. But they did a lot of all that work, and they came up with that London is underfunded. I mentioned 2,500 beds per annum till 2026, including the Olympic Games, and that's how they feel about it. It's just the fact that London it has had a strong economic side, but also it's everyone helped on many different levels, many different industries across many different sort of interests. But there's the same kind of appeal for tourism as well. So that's their opinion, and there's numerous other opinions. Deloitte, they do a lot of every year. They do another show. They talk about where they see the market going and the rest of it. The lovely thing about this is you can get yourself just by going to TRI, just by going to Deloitte, just by looking around, you can get so much information in the public domain about the appetite, about London, and about these buildings. Don't forget.
In a very different way. I mean, what was the average occupancy rate in the 1990s or in 1980s in London? Do you know that number?
Limited computation. So
basically, we have to go back to history as well.
We can, but in all fairness, that will tell you whether in one point in time occupancy dropped to a certain extent. And if I remember my statistics from the old days, we need to go probably on a time series basis and find out what was the event that really dropped that occupancy, and what's the probability of that event or something like that recurring. And I think the graph shows, and nobody really knows what could bring London down for 6 months. Yeah. Tomorrow you have bird flu running in the center of the city, and you shut it down for 6 months. But if you run a business on a long-term basis, it will average out. Okay, and I think that's the first thing that people are attracted to. What's the room rate? What's the occupancy? And there are fundamentals of the business. But if tomorrow government changes legislation and you have to employ many more people to operate the businesses, what would that do to the bottom line for property? How much more risk they're taking, as opposed to an owner that just get the room? The owner would not be impacted by that at all. And I know I take care of the owners, but they're risking most money, so I think they deserve that attention. The operating company in this case assumes more responsibility than a management contract, a company that manages property under management contract, because they risk nothing, effectively, unless they have a guaranteed fee. So these guys, they do share operational risk with the owner. They don't share the equity, but they share the operational risk. And they don't commit to a predefined sum of money, but they do share the operating risk.
I have another question. In terms of valuation, this is a typical, it can be seen in a different way as a buy-to-let, in which instead of letting it for 3 to 6 or 9 per year, you are really letting it per day, to be honest. Equivalent kind of analogy, in better analogy. What is typical kind of a PE type of ratio here versus equivalent property in the same place?
It's a valuation question, what you're asking effectively. What is the multiple, what is the net initial yield or reversely the multiple of a property like that?
Can the property value?
We don't value properties like that by the European or UK or standard based on multiplier in that sense for hotels. The preferred way of doing it is a discounted cash flow method. And that would imply a multiplier at the end of the calculation, not as a way, it's a derivative of the calculation, not a method of projecting. Now there would be industry standards. So if you go today and you search operating companies, for example, on a larger scale which are publicly traded, you would get EV multiples, EBITDA to EV multiples, that will imply something in the order of 14%, 30 multiples of 13 or 14 or 12, depends on the company, which means technically you take the EBITDA of the company and you multiply it by that number, and that will be the enterprise value. Fine. It doesn't tell you when you go and you look at a specific hotel, what is the multiple of that hotel. So this entire debate of multiples for hotels, and that ignites the debate about CAPM and equity pricing for property. It's completely unhelpful, if you like, as an industry benchmark. It's really, really difficult to look at it from that perspective. What we would like to do is really analyze the macro and microeconomics of the property, understand the supply, the demand, who else is coming in, how well the business is operated. Okay, so a group like Guest Invest, for example, or any one of you, okay, or Blackstone, or any Morgan Stanley would go and buy this property. They would look at the P&L as it stands today, and they will see, for example, it does 15% NOP because mom and pop are still doing it by themselves. Okay, and they'll think, okay, the market, this property should do 30%. This is how much more we can do, and they will do 30% from a rate which is on a global distribution basis and proper marketing. Okay, and that's where the added value comes from. That's where the asset management comes into play. So the multiple of the property that is badly managed is going to be so much more significant than a stabilized property. Okay? Look at it differently. If you buy a hotel that is working 75% at the rate of £50 a night, okay, or 85% at the rate of £50 per night, you take it out of commission for 9 months, you fully refurbish that, and you open at £150 and 60% occupancy. Have you done worse or better off on the first year? What does it mean from a yield perspective? It doesn't mean a lot. So you would look at it from a valuation perspective. You don't really want to look at it on that basis necessarily of the first year. So multipliers will not be that helpful. It's a very useful tool for bankers, because if you're lending today in the UK interbanks, LIBOR today is around 6.8, I think, still. So that would be challenging to syndicate, for example. Okay, because if you make 6% and the cost of borrowing is above 6, then you struggle. That's one of the things you syndicate.
Yeah, I think the question I was trying to make was a bit in the following terms. If there is a correction in the UK market in the near future, because we all know that the market is overvalued, okay? And the buy-to-let or buy as well, people tend to say that can be 20, 30, 50%. Okay? And that evaluation can be measured by P ratio, I mean the price of the property versus the earnings of that property per year. You can do that in a crude way, or you can do a PD as well. Okay? So if that correction occurs in London, for example, do you think that there will be a correction also in the price of these rooms as well or not?
I don't know. All those valuations are done on paper. Okay.
Yeah, but historically, you do a chart of 50 year where historically that's
fine.
The ratio of the property was measured. And we all know that
that's fine. But if you bought a US dollar a year ago, okay, and by now you will have lost some money against the pound, yet another year, maybe in 5 years' time you'll be in a different place in the life cycle. So when it comes to property, and you talk about fairly illiquid asset class anyway, it's very important when you exit, when you come to that. So when you're looking at the numbers, and I'm looking at the buildings, apologies for that. It's not just the income stream that we look at. It's important when you exit.